Major policy initiatives from the Trump administration, well, they're coming out thick and fast. And the tariff blunderbuss, that's now being aimed at Europe. And the prospect of a peace deal on Ukraine, well, that's put European leaders in disarray. So in this week's Market Perspectives, we're going to try and work out the impact of all this on the economies here in the UK and in Europe. Let's start with the tariffs. Now, yes, the threatened tariffs on Colombia, Mexico and Canada, they weren't implemented, at least not yet. But we do think that Europe is going to face tariffs. We expect tariffs on steel and aluminium to be implemented from the 12th of March, with what are called reciprocal tariffs after the 1st of April. Now, the tariffs on steel and aluminium, if set at the full 25%, that would obviously have a big direct effect. But the overall size of US-EU trade in this area is pretty small. And there'll be indirect effects where steel from Brazil, for example, destined for the US and aluminium from elsewhere is dumped on Europe. And that's potentially a lot more damaging, but there are mechanisms in place to deal with this. Now, reciprocal tariffs, and that's where the US levels up its tariffs to match those levied by Europe, well, they would be more wide-ranging. And for some specific product categories, the impact could be pretty big. Now, in response, the European Union is offering to lower some of its tariffs, for example, on autos, and to buy more LNG and defence equipment from the US if Trump pulls back from implementing tariffs on the European Union. Now, that would be good news from a macro perspective, actually for both sides, but there is as yet no concrete agreement. The US is less affected by all this, given that we run a broad trade balance with the US and our exports are focused more on services, and they are not subject to these threatened tariffs. Now, relations between Washington and the EU capitals, they are distinctly frosty at present as a result of Trump's approach to Ukraine, where he's attempting to secure a peace deal directly with Putin, cutting out Europe and indeed Ukraine. Europe's political leaders, they can't agree amongst themselves, and they are terrified by the prospect of having to face Russia directly, for example, via a peacekeeping force following a ceasefire without US support. And Article 5, that's the Mutual Defence Agreement, which in effect allows Europe to shelter under the wing of US defence, that could then be called into question. Now, from a macro perspective, there's a good chance that this will lead to a fiscal expansion in Europe. They'll be forced to increase defence spending, and indeed Brussels is contemplating easing the fiscal rules to facilitate this. Meanwhile, in Germany, if next week's elections deliver the two-thirds majority for centrist parties that are needed to amend the constitution, it's likely that the debt brake will be eased. Now, with low interest rates and weak economic growth, fiscal easing, well, that'd be good news for the European economy. The UK, well, fiscal policy here is heavily constrained, and the Prime Minister has recently said he has no plans to further increase defence spending in the UK. Energy prices, which were forced up by the war in Ukraine, they've been rising recently for other reasons, but they are likely to fall significantly over the medium term, whether or not there is a ceasefire in Ukraine. And we've discussed all this recently in other market perspectives. Now, added to the direct effects of the policy blitz from Trump, it's all the uncertainty it creates, which can deter investment and spending more generally. And we will be taking a close look at the Purchasing Managers' Indices, which are released later this week, to get some clues here. Now, all this has taken place against a background where the Eurozone economy has been slowly improving. And although the UK has enjoyed some better than expected GDP data last week, the next few months will be distinctly challenging as hefty tax increases are likely to raise both inflation and unemployment. So where does all this leave financial markets? So we are cautiously optimistic on risk assets given the global economic recovery and falling interest rates. And indeed, equities, notably in Europe, they've shrugged off all this negative geopolitical news. And we hold to this view given our assessment of the impact, though we do prefer the US market, where the uncertainties just seem to be less. So until next week, goodbye.